But if I were doing that, this is how I would teach you. I would start off with something just like this, and it will allow you to formulate an immediate road and pathway for you to decide, what does that mean for me? Do I want to be a scalper? Do I want to be an intraday trader? Do I want to be a swing trader, a short-term trader? Do I want to be a position trader? Where are you with that? And in the beginning, I wanted to be a swing trader because I had a job. I couldn't do those things being in front of the charts. And by me studying intraday charts, I started thinking, I'm missing moves because I'm not trading intraday. And I got tripped up in thinking that that was the only way you can make money, and it's not. Now, for the working class hero, this is for you, okay? You can't trade intraday charts. You can't trade the smaller time frames because you just simply can't do it. That is not a problem. Okay, it's not. All you have to do is change your perspective a little bit. Okay, using the same thing I just did here. Now we're going to apply a different mode of thinking with the same underlying market conditions. Now, think about what we've done here. Close proximity to liquidity on a daily chart. That means intraday, the market's going to trade down to that low. If you're using intermarket relationships and it's the dollar index that you're doing the analysis on, it's likely to do something like this. That means that the Forex pairs that have the dollar index in the second name, for instance, the dollar's going to go down. Should be charging you money for this, man. I could be paying my bills. I could be getting out of debt. What is debt? What does that even mean? What does that mean, debt? I don't know. I haven't been there for a while. So pound dollar, euro dollar, Aussie dollar. So that means the pairs that have the US dollar second in its name, when it's opening here on the dollar and it's going to drop down into that low and below it, okay? When it does that, these types of currencies in Forex are going to go up until the liquidity below that low here is taken. Then the easiest low-hanging fruit objective for you is to sell your euro long, pound dollar long, Aussie dollar long. Now, for currency pairs that have the dollar index in the front of the name, that's USD, JPY. I hate that pair. I hate the yen. Dollar Swissy. Okay. And they will do the same thing. They will mirror what the dollar index will do. So there'll be some kind of a low that they're reaching for too. But you want to make sure, here's this very important. Please don't miss this point, okay? When you're trading with positive correlated Forex pairs with the dollar index, and your analysis is being framed on the dollar index all the time in Forex, always. If you're not trading with the dollar-based idea, you are trading blind. I promise you, you are not finding the success that you could have if you're avoiding this part. This part here is important for currency trading, because what your opinion is about the dollar index, until it's completely gone, it's the daddy. Okay, so we're in close proximity of this low for dollar. It's going to likely draw down to that. Dollar yen, dollar Swissy, they're going to drop too. But the low here's the kicker. The low that may be also something that you're aiming for, relatively the same time that this is being formed. So in other words, on Tuesday, July 1st of 2025, there might be a low on the dollar yen or the dollar Swissy, comparably at that low, but it may not take that low. How could that possibly happen? If the dollar's going to take its low, why wouldn't the dollar yen and the dollar Swissy take its low? SMT. Now, right there, that has cleared a whole lot of cobwebs for some of you out there. Okay, because you think everything should be 1, 2, 3, ABC. The rules never deviate. There's never any kind of you know, departure from what you think in your infancy and learning initially versus what the realities in the marketplace is. So having the analysis anchored to the dollar, that means when this low is taken there, that is when you close your short on dollar yen, dollar Swissy. or any pair that starts with the dollar in the front of the name of the pair. Remember, these up here with the dollar index to the right, there's a second name in the title of the pair, they're going to be moving the opposite direction. Okay. So, very, very important. You have to keep in perspective what the dollar's doing, because if this thing's going to move, it's going to affect the currency pairs that you're trading. And SMT, which is a divergence. And visually, let me do it this way. Um, that's essentially what we're expecting in dollar. That low, this low piercing that low. That's the old low. This is the low we anticipate forming below the previous one. That's this visually here. But we may see comparably, we may see a low in the dollar yen, and it's getting real close to it, but it may not go all the way below. It might go right just above it and then pull away. And then you have the dollar Swissy. It might agree and go that slightly lower low. But what do we have? We have a divergence in positively correlated currencies. Dollar index based with the dollar in the front of the name, with the dollar index itself that we're showing here in chart form. This is what we anticipate in dollar. This is the reality. With yen, it says, no, I'm not going to go lower. And this here does go lower. If this happens, that could be indicative of a shift in internals that's going to support or cause a larger magnitude reversal mindset on the dollar index, because big money, remember I was telling you earlier at the beginning of this live stream, is that they don't have the benefit of going into the marketplace on a very small short-term time frame. They have to move throughout blocks of price action that they have to implement over time. It can't be their full positions placed on right now, because they're trying to hide what it is they're doing. And they also have to use the available liquidity that's available in the marketplace. There isn't always the amount of liquidity at that tick in the next 1 minute candlestick time frame. All the price action that took place in that 1 minute or 5 minute candle isn't enough for all of these banks globally to shove all their orders in on that one candlestick. Okay, so that's not what they're doing. They're not trading on one candlestick entry and that's it, and then we're done. But what they're doing is they're accumulating the sell stops below here, and then they're buying more at that opening price. And that's where you, working class hero, that's you, Mr. I can't be in front of the charts intraday. If you're a working class hero type trader or in the process of becoming one, you don't need an intraday chart. How can I take this information and use it? Okay. You can have the same expectation and anticipate that they're going to drop from that opening price down there. When does the dollar index open? That's very simple. That's a time that never changes. It's simple. That time, whether you have a job or not, your phone has an alarm clock, right? It should. You probably use it to wake up, to get ready to go to work. You set it to see what time the dollar index or whatever that pair or whatever, I'm sorry, not pair, that market opening price is anchored to. If you're going to be using um, index futures, you're going to have to decide whether or not you're going to use settlement price or non settlement price. You have to determine those things. I tell you always refer to both. And back testing and studying, it'll tell you which one you want to use if you're going to use this approach to doing it, which is non intraday based. But now, if you anticipate that price opening on that candle, and you want to be a participant in it, you get the opening price, see when we're in close proximity, like as soon as they close here like that, okay, wonderful. Then wait for the new candle for the daily chart to open up, get the opening price. then you know that it's likely to traverse and go down to that low, and you want to see it trade below it. As soon as it does that, as soon as it gives you this information, you already know that you can have a buy stop. Okay. You don't have to be in front of your charts. It's on autopilot, complete and utterly nothing to worry about. You can apply this to index futures. You can try to trade it with Forex pairs. You can do it with stocks. You can do it with commodities, bonds. I'm not going to say anything with crypto. Okay. I know you see me doing some things with crypto, and that's just simply because I've been inundated with people. Please, 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 please. Once in a while, I'll share my ideas. Okay. But Bitcoin's going to zero. So stop bothering me. Okay. Just leave me alone. So the idea is that once it does this, you're not in front of the charts when it's doing this. You don't need to be. As soon as it comes right back up and hits the opening price again, if your premise is correct, if you are right about the ideas that you think that it's going to go down here and take the liquidity and then start the run on a smart money reversal basis, are you getting long down here at the low on turtle soup? Nope. Do you need it? Nope. Because your idea is it's going to go up to, now here's the test for you guys that have been studying through my private mentorship. Where is the draw after smart money reversal? It's a trick question now. Pause the video if you don't want to know. If you're watching it in real time here, I don't have the luxury of doing that, but you're going to be forced into the answer right now. So what you do is you want to take your high down to the low that formed intraday, and it comes back to that opening price. As soon as it comes back to the opening price and trades one tick above it, you're immediately inside of a new buy program. So this is kind of like a little play on words with order block theory. It's the reverse. Yeah, how about that? Wonderful. You'll get more information in the book, don't worry. This opening price on that candlestick, as soon as it hits that, you can be long. But inside of this, where we at here? Here we have the high, and this would be the original consolidation, or where the draw would be on a perfect market maker buy model. Market's going to go up here. But in your infancy as a developing smart money concept trader, you don't hold to that idea all the time. You have to have a low hanging fruit objective. What would that be? 3/4 of the move, okay, or optimal trade entry. Because if you studied with me and you went through private mentorship, you know that a market maker buy model and a market maker sell model does not have to go all the way back to the original consolidation or opposing liquidity. That's just the best case scenario. Now, best case scenarios are just simply that, a scenario. They're not an absolute. They're not a panacea. They're not a be all end all. It's going to only happen this way, like you think it should as a new trader. New traders think that way. It has to work like this all the time, or I don't want nothing to do with it. Go do something else, because that's not what the market's going to do.